The Automated Budget and Financial Analysis tool is an extremely powerful fully automated financial tool for budgeting, short-term and long-term cash flow simulation, P&L variance analysis, business valuation, etc. An user can prepare a comprehensive budget, forecast, simulation report for any type of business, be it manufacturing, trading, project-based services, subscription-based services, etc., and doesn't need to have any financial accounting knowledge to use this tool. The tool is Excel-based and hence can run on any computer with MS Office. How to use the tool. The tool has one input sheet where all the user inputs are entered. Only the yellow-colored cells in the input sheet are editable, with all other cells completely protected from editing. The tool has the following reports. A. Projected monthly and yearly income statements. B. Projected monthly and yearly cash flow statements in both direct and indirect methods. C. Projected monthly and yearly balance sheets. D. IRR, NPV and project valuation reports. E. Detailed ratio analysis. F. P&L variance analysis report. G. Charts. The input sheet is divided into various segments like general, equity, borrowings, revenue, direct costs, operating costs, Capex, etc., with each segment highlighted in bold red fonts. Now we will cover each segment in detail. 1. General segment. In the general segment, the user shall enter the following details. A. Currency. B. Budget, forecast beginning month. C. Number of months for which the budget forecast is to be prepared. The user shall then click on the Generate Template button and thereupon, the tool will create the reports for the required period. Two. Equity segment. In the equity segment, the user shall enter the months when equity is to be planned to be brought into or taken out of the business, along with the equity amounts for each of those months. The user may add additional rows for data entry using the Add Rows button. Once the data is entered here, it will be automatically updated in all the concerned reports. Three. Borrowings segment. The Borrowings module in the tool has one of the world's most advanced loan modeling functions. A pioneering feature here is the auto-generation of loan repayment schedules for any number of loans the user may input into the tool and the auto-population of the workings, borrowings, repayments, interest computation, into all associated reports without any manual effort by the user whatsoever. In the borrowing segment, the user may enter data for any number of loans that the business is planning to borrow during the forecasting period, and the tool will automatically update the various reports with the interest, repayment and loan balances for the forecast period automatically. Thus, the cash flow reports will show for each period amounts received as loan, repayments on account of interest and principal separately. Likewise, the balance sheet will populate the amount of loans outstanding as at the end of each period, and the income statement will likewise show the period-wise interest on loans. In case the user wishes so, they may click on Generate Schedule of Loans button, and the tool will automatically generate a detailed loan schedule report of each individual loan entered by the user as a separate file which can be saved by the user. In case the user has a cash credit overdraft facility, they can enter the interest rate chargeable under the section Overdraft Cash Credit. Interest is then automatically applied whenever the projected bank balance is overdrawn. This can be verified in the projected monthly cash flow report. 4. Revenue segment. The tool allows a user to define an automated revenue model for any business type, be it manufacturing, trading, services, project-based, subscription-based, etc., or any mix of these models. The revenue segment is divided into two, Part A and Part B. While Part A can be used for revenue items with unit pricing, Part B can be used for project-based revenue items. While using Part A, the user can add any number of products, services using the Add Product, Service button. After adding required rows for the products, services, the user then enters each product, service name along with its unit selling price. Once the products, services are defined with their unit prices, the user next proceeds to forecast the output or quantity for the products, services using two tables, namely, Table 1 and Table 2. Now, we will explain how to use Table 1 by means of an example. Assuming the business is planning to sell 1,000 units of product A from January 2021 to May 2021, 1,200 units from June 2021 to September 2021 and 1,500 units from October 2021 to December 2021, the user will add two columns, one for June and another for October 2021. The column for January 2021, which is the budget beginning month in our example, is present by default in the input sheet and need not be added separately. The user will then enter 1,000 units against January, 1,200 units against June and 1,500 units against October. Based on the data entered above, the tool will forecast monthly output from January to May 2021 at 1,000 units every month, from June to September 2021 at 1,200 units, and so on. It may be noted here that the tool will automatically take the immediately preceding available monthly output data for months not explicitly defined by the user. For example, above, we have added only two columns for June and October 2021, since these are the months when a change in output is forecasted to happen. The intervening months between January and June will automatically take January's output as their values, and so on. In the given example above, the tool has already forecasted sales till December 2021 for product A. If the user believes that there will be a monthly increase in product A's sales by 200 units effective from January 2022, then they will enter 200 in January 2022 in columns C and D against product A in Table 2. The user can also fix a monthly maximum output ceiling for each product, service separately, and the monthly output, sales, will automatically stop incrementing beyond this limit. In our case, we can fix a monthly cap of 2,400 units for product A. In the above example, product A's projected output, sales from January 2022, is incremented by 200 units every month till it reaches the monthly cap of 2,400 units in May 2022, beyond which the monthly output, sales, will continue to remain at the capped units. Part B of revenue segment is used for forecasting revenues for services, projects without unit pricing. As in Part A, a user can add any number of rows for accommodating any number of services, projects in Part B. This can be illustrated by means of an example below. Name of revenue item, Project X. Billing frequency per annum, 6. Revenue amount per billing, 100,000. Month applicable from January 2021. Month applicable till January 2024. Revenue increase percent after n months, 10%. Increase frequency in months, 12. For the given illustration, monthly revenue for Project X will be 100,000 for January 2021, nil for February 2021, 100,000 again for March 2021, nil for April 2021, and so on till January 2024, which will be the last month of billing for Project X. Where billing hike is defined, 10% every 12 months in the above example, the billing will increase by the specified percentage on a compounded basis every n months. Thus, in the given illustration, billing from January 2022 to December 2022 will be 110,000, while billing from January 2023 to December 2023 will be 121,000, 10% hike over 110,000. Detailed workings for the revenue items are available in the Workings section below Projected Monthly Income Statement Report.
Five, direct cost segment. Direct costs are automatically computed by means of highly advanced algorithms, and the user is only required to define the direct cost items with their unit prices, and express input-output relationship between the direct cost items and the products or services. The user can add any number of cost items with their respective unit costs using the Add Cost Item button. For instance, we can assume that the business has 4 direct cost items, say, direct cost 1, direct cost 2, direct cost 3 and direct cost 4, with their respective purchase costs as 100, 20, 30 and 350 per unit respectively. Upon defining the direct cost items with their per unit rates, the user shall next proceed to enter values expressing the input-output relationship between the direct cost items and the finished products or services. In the given example, let us assume each unit of product A requires 2 units each of direct cost 1 and direct cost 2, 1 unit of direct cost 3 and 4 hours of direct cost 4, assuming direct cost 4 is a direct labor cost. Likewise, for each unit of product B, we can assume values of 3 units of direct cost 1, for units of direct cost 2, 0 units of direct cost 3 and 1 hour of direct cost 4. Upon entering the values as given above, the direct cost values are automatically computed by the tool by means of programmed functions, and the values can be viewed under Workings section below Projected Monthly Income Statement Report. Taking December 2021 as an example, forecasted sales of Product A and Product B are 1,500 units and 2,000 units respectively. Fetching direct cost quantities from the relationship table, the tool computes direct cost value for direct cost 1 for December 2021 as 2 times 1,500 units of Product A times 100 per unit plus 3 times 2,000 units of Product B times 100 per unit equaling to 900,000, and so on for direct cost 2 and the rest. Here, Service A and Service B are ignored in the direct costs computation, since there is no consumption of any direct cost items for these 2 services, as can be inferred from the relationship table where the relationship between the direct costs and products or services are expressed. From the above example, it can be inferred that for traded products, since the direct cost and their corresponding output product, service items are one and the same, the value to be entered in the input-output relationship table shall be 1 in the cell the direct cost, and finished product items converge in the relationship table. The direct cost modeling algorithm also has a powerful feature wherein a user can shift each direct cost's occurrence to X number of months before the month of sale, X being defined by the user separately for each direct cost item. This may be necessitated in manufacturing scenarios where a direct cost item remains as a work in progress for few weeks, months before the finished product is produced or sold.
6. Employee cost segment. A very unique feature of this tool is that a user can forecast, simulate employee costs by each department extremely accurately. The user can add any number of departments specific to their business using Add Department button. For modeling headcount by department, the user can use two tables. Let us assume the projected headcount for IT department is 4 employees in January 2021, 6 employees in December 2021, with the headcount anticipated to increase thereafter by 1 employee every 3 months till a ceiling of 10 employees for the department is reached. In the second table, the user will enter 3 against the field, recruitment every n months, enter 1 against the field increase in numbers, and finally enter 10 against the field ceiling on number of employees. Accordingly, the projected number of employees in IT will be 4 employees from January till November 2021, 6 employees from December 2021 to February 2022. Thereafter, the number of IT employees will increase by 1 employee every 3 months starting from March 2022 till the IT headcount attains the defined ceiling of 10 employees. The user can then define monthly average employee salaries and annual raise increment percentages by each department separately. 7. Operating cost segment. The user can model operating costs in 2 different ways, depending on their behavior. This can be illustrated by means of an example below. Name of operating costs: electricity. Cost frequency per annum: 6. Cost per billing: 15,000. Month applicable from February 2021. Month applicable till December 2099. Since electricity costs are expected to recur periodically as long as the business is in operation, the user can enter any date falling after the budget end date fixed by the user, say, December 2100 or December 2099. Cost increase percent after n months: 5%. Increase frequency in months: 24. For the given illustration, monthly power costs will be 15,000 for February 2021, nil for March 2021, 15,000 again for April 2021, nil for May 2021, with the pattern recurring throughout the budget period since it is defined by the user as a permanent cost. There will be a biennial compounded increase in power costs by 5% in the given illustration. Certain operating costs can be defined as a percent of an underlying variable, say, percent of sales or percent of employee costs or percent of direct costs, etc., and such costs are defined in the second table under this segment. For example, if commission is determined at 3% of gross revenue, then define the direct cost head as commission, select basis as percent of sales, and enter percent as 3. Accordingly, commission will be worked out at 3% of monthly sales. Eight. Capex segment. Under Capex segment, the user can define any asset type group, say, building, plant and machinery, office equipment, etc., along with their respective depreciation rates and their opening balances, only applicable in case when the forecast budget is prepared for an existing business. In the next table, The user can do the actual Capex budgeting, that is, enter the expected month a particular asset is to be acquired and the amount of acquisition. Upon doing so, all the relevant values will be accurately reflected in the respective reports: depreciation in the income statement, written down values in the balance sheet, and acquisition, disposal of Capex items in the cash flow reports. (9) Investments segment. For modeling investments, advances, deposits, like utilities deposit, rental deposits, and their redemptions, the user will use this segment. 10. Other assumptions segment. Under the Other Assumptions segment, the user will enter average collection period for determining receivables, average payment period for determining payables, inventory holding period for determining inventory, rate of return (PA) for computing interest on investments, among others. Consider an average collection period of 59 days, for example. In the given model, projected sales in January 2021 is 1,100,000. Since the average collection period is 59 days, the sale will be realized only in March 2021. We can now change the cash-credit sales split in the input sheet, presently at 100% credit, to 40% cash and 60% credit, and assess the impact on the cash flows. Now, the sale realized in January 2021 will be 440,000, 40% being cash sales, while the sale realized in March 2021 will be 1,100,000, computed as 40% of March 2021 sales, equaling 440,000, representing the cash component, realized in the month of sale itself, plus 60% of January 2021 sales, equaling 660,000, representing the credit component, realized 59 days after the month of sale, that is, March 2021. A similar logic is applied while determining monthly vendor payments, thus allowing for cash flows to be modeled extremely accurately. 11. Opening balance sheet segment. This segment is applicable only for existing companies. The user shall enter opening balances prevailing on the date immediately preceding the budget beginning date. 12. Customer receipts and direct cost payments segment. In this segment, a user can override the system computed customer receipts and vendor payments for any month or months. (13) Import of actual income statement, trial balance segment. A very unique feature of the tool is a fully automated budget versus actuals P&L variance analysis report. The user can import raw P&L report trial for any number of months in one go without having to manually format the raw report before importing, like removal of report headers, realignment of columns, etc. The tool then proceeds to fetch data from each raw data file and gives a comprehensive budget versus actuals P&L report month by month for easy analysis. As explained above, this is an entirely automated process from start to finish. (14) Reporting currency segment. In case the user wishes to present the reports in a different currency from the one they used for entering the inputs, that is, base currency, they can use this segment for changing the reporting currency to the desired one. Accordingly, the values in all the reports get converted into the reporting currency. Finally, the user can export the reports generated in the tool as a separate report file for distribution to various stakeholders by clicking on the Save as Report button. The user can generate reports from 3 months to even 30 years and beyond using this tool. . 15. . 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. 15. In case you need a trial version of the tool, please reach out to us at support@gmtechanalytics.co.in. We will also be quite happy to answer any queries you may have relating to the tool. For buying a perpetual license of the Budget and Financial Analysis tool, please contact us at sales@gmtechanalytics.co.in or visit our website gmtechanalytics.co.in. Thank you.